Welcome back to our channel. Today we're diving into one of the most critical turning points in American history. Picture this. It's March 5th, 1933. The nation is in the grip of the Great Depression, and panic has gripped every corner of the financial system. Newly elected President Franklin D. Roosevelt steps into office and takes an unprecedented stand that would forever change the course of American banking history. Banks across the country were on the brink of collapse. News of financial instability spread like wildfire, and desperate depositors rushed to withdraw their money. This wave of panic withdrawals created a dangerous liquidity crisis, forcing many banks to call in loans and face insolvency. In this moment of crisis, Roosevelt knew decisive action was necessary. To combat this financial freefall, Roosevelt proclaimed a four-day bank holiday. But this wasn't just a pause in banking activities, it was a strategic reset. By temporarily closing the banks, the government could step in, assess each institution's financial health, and ensure that only the solvent ones would reopen. It was a bold move designed to restore public confidence in the banking system. Central to this plan was the Emergency Banking Act of 1933. This landmark legislation provided the legal framework for the bank holiday. Under the act, every bank had to undergo a rigorous inspection before reopening its doors. The goal? To weed out the weak links and stabilize the entire financial system. And the effects were almost immediate. During those 4 days, federal officials evaluated the health of banks across the country. By halting the wave of panic withdrawals, the government was able to inject much-needed stability into a system on the edge of collapse. When the banks finally reopened, Americans saw a renewed sense of security, transparency, and strict regulatory oversight had been reestablished. The impact was dramatic. By the time the bank holiday concluded, more than half of the cash that had been hoarded by anxious depositors was reintroduced into the banking system within just 2 weeks. But the most striking sign of renewed confidence came on March 15, 1933. On that very day, stock prices soared, marking the largest one-day percentage increase in history. This wasn't merely a market rally, it was a resounding vote of confidence in the government's bold intervention. Roosevelt's decisive actions during this turbulent period exemplify the transformative power of strong leadership in times of crisis. By shutting down banks temporarily and implementing strict inspections, his administration not only protected individual depositors, but also prevented a cascade of bank failures that could have further deepened the economic downturn. Today, the events of March 1933 serve as a powerful reminder of how restoring public trust in financial institutions is essential, especially during economic emergencies. Roosevelt's bold measures laid the foundation for a series of reforms that eventually pulled the nation out of the Great Depression, setting a precedent for crisis management that still resonates today. If you found this dive into history insightful, don't forget to hit that like button, subscribe, and ring the bell for more stories from our past that shape our present. Leave your thoughts in the comments below. What do you think about Roosevelt's bold move back in 1933? Thanks for watching, and see you in the next video.